Hi, my name's Kellie Wood. I'm the Head of Fixed Income here at Schroders. And today I will be giving you an update or portfolio review on the Schroder Fixed Income Fund. Where have we been over the last year, where we're going, and how we're positioned for the fixed income outlook over the next few years. So 2024 has been another volatile year for fixed income, but with that volatility, we have seen some great opportunity across countries, but also asset classes. You can see on the slide, we started 2024 in this environment where growth was holding up, inflation was moderating, and central banks were holding cash rates at high levels. And it wasn't till the middle part of 2024 that we did start to see growth moderate. Inflation was already coming down, and it was when central banks could actually start easing policy. But as we closed in on 2024, we started to move back to this higher for longer environment. Growth was resilient, inflation was stickier, and the election result of President Trump has supercharged this higher for longer environment. Credit markets, on the other hand, on the right-hand side, have fully embraced this soft landing view, an environment where growth holds up, inflation's moderating, and central banks are cutting interest rates. So credit markets have seen very strong returns, not only in 2023, but also in 2024, setting up a very good environment for next year's returns. If we look back on 2024, one thing that was different from 2023 was the dispersion in returns. And this is where there was a real need to be selective. We saw cash returns just over 4% in line with Australian government bond returns. And this is where we started to see the divergence, where Australian bonds have really outperformed global government bonds over the last year. And that has been the case in the government space, but also in credit. You can see that Aussie investment grade credit posting returns of 6.5% versus global credit of 3.7%. So Aussie bonds outperforming global bonds. And this is one of our key themes for 2025, is we are now in this environment where we see a huge outperformance of Australian bonds versus global bonds. High yield markets have been very strong performers over the last few years, Australian high yield and global high yield, where markets like emerging market debt have underperformed. The pressure on this US exceptionalism, higher US dollar, higher US interest rates has really put pressure on EM returns. And that has been one market we've been a little cautious on. So what could 2025 look like? So if we think back over this cycle, one thing that's been very different has been the volatility around market expectations as to what landing central banks can actually deliver. Will it be a soft landing, a hard landing? Will there be no landing? And we have been heavily positioned for a soft landing, and an environment over the last few years where central banks are easing, where growth is holding up and inflation is moderating, which has been a very good environment to holding credit risk within your portfolios, but also interest rate risk. And this has delivered some great outcomes for us over the last year in terms of absolute, but also relative returns. But what we've seen over the last few weeks into January has been this view of sort of no landing in the US, where we're seeing growth hold up, inflation remaining relatively sticky, and the possibility that the US Fed gets stopped out of its easing cycle. And in that environment, we want to be using fixed income for income, accessing high quality income, rather than capital appreciation, which is what we've seen in this soft landing environment, strong performance from credit and rate markets. And if we think about the Australian economy, there is a real chance that 2025, the RBA will engineer a soft landing. And the RBA has actually sat out of this global easing cycle. But 2025, if the RBA pull forwards their easing cycle, we will likely to see, again, strong performance from Australian bonds over global bonds, US, for example, in this higher for longer environment. If we think about this high reset in terms of yields as we came into this year, that high yield actually provides some support for more capital volatility in interest rates if we do move back to that higher for longer environment. You can see on this chart, we're looking at our three flagship fixed income products: the Fixed Income Fund, the Absolute Return Fund, and the Australian High Yielding Credit Fund. And we've taken the positions of those three portfolios and modelled the 1 year returns over those three different scenarios: no landing, soft landing, and hard landing. And what you can see is that in the no landing environment, this higher for longer environment, we see credit markets continuing to deliver better returns, our high yielding credit fund being the best performer over that 1 year period. In the soft landing environment, it is the fixed income fund that delivers the strongest returns, 11% returns. In an environment where yields continue to come down, we see good performance from credit spreads. And in the hard landing, it is really where the fixed income fund comes into its own. A fund that has a lot more duration risk or interest rate risk that actually protects from that equity volatility. An environment where yields are collapsing 200 to 300 basis points and we see a huge widening in credit spreads. That is the environment you want to be owning a lot of duration or interest rate risk within your portfolios. Our current asset allocation views are reflective in our portfolios. And what we've seen over this last year is a real dispersion on valuations across the global fixed income universe. We're having a preference to asset-backed securities, not only in the US, but also in Australia. Here we can access high quality income for AAA assets around 5 to 6%. In investment grade credit, our preference is towards Australian and European investment grade credit markets. Here we've got better valuations than the US and we have strong cyclical support. In high yield, our preference is towards Aussie high yielding assets, bank subordinated debt, around BBB in terms of credit quality, and yields of around 5.5%, 6%. And that's where we're seeing better valuations compared to European and US high yield, where we see valuations as being more expensive. And in emerging markets debts, we have been quite cautious on this asset class, just given the rise in the US dollar and rising US interest rates. In terms of our rates and inflation views in regards to duration, our preference is to be owning Australian and European interest rate risk. They are the two markets where we believe the central bank should be easing more than what's priced into markets, and we're seeing strong valuations. Compared to Japan and the US, where we see further underperformance of those markets, an environment where US rates are continuing to underperform, and the possibility that the US Fed actually gets stopped out of its easing cycle. We expect the Bank of Japan to continue to hike rates into 2025 and further underperformance of Japanese yields. Across curves, we have a bias towards steepening. This is where we're owning a lot of our interest rate risk at the front of the curve. We have concern around the back end of the curves in terms of this re-establishment of a higher for longer view in the US and the re-establishment of term premium along fiscal concerns. And inflation, our preference there is to be owning inflation protection in Australian and the US. We believe inflation is underpriced in the US market and we're looking for higher inflation break-evens. So those asset allocation views are reflected in our portfolios for the fixed income fund. Our positioning at the end of December 2024, you can see the bias there towards credit in the blue, over government assets in the purple. We have a strong bias or heavily biased towards this soft landing, where we see 85% of our portfolio denominated in Australian assets. And again, this is back to this view of Australian bonds outperforming global bonds. Our most preferred assets in investment grade is Aussie investment grade at around 28% and European credit around 7%. Those two allocations are followed by mortgage-backed securities around 14%, and that's pretty evenly distributed between Aussie and US. Australian high yield at around 11% is our most favoured high yield market. The yield to maturity on the portfolio is around 5%, has a very high average credit quality, and you can see in the duration versus spread duration, we have a preference to be owning more credit risk versus our benchmark than duration risk or interest rate risk. And inflation duration around 0.45. Here, ensuring that we have inflation protection within our portfolios in this environment where we believe inflation is underpriced, especially in markets like the US. So overall, we think 2025 is a great year to be investing back in fixed income with the re-establishment of yields and very toppy valuations in equities. We think fixed income is primed for some great outperformance, especially Australian bonds versus global bonds.